So we hear it all the time in crypto that it's super volatile. In this video, I want to talk about what is volatility, how volatile is crypto, and provide a historical analysis on how we're getting less volatile over time and what that means for us as crypto investors. If it's your first time dropping in, my name's Zach here on the channel. We just bring it to you quick and easy, not a lot of flashy editing, just like to give you the news, give you the information, and you can hopefully take that information in and make better investing decisions. And this question of volatility is something that always comes up, right? So let's dive in. And real quick, if you could smash the like button, that would be fantastic. It's the best way to give back to us as creators here on YouTube, helps spread these videos to other audience members. So, what is volatility? I want to start right here. Volatility is the measure of how much the price of any particular asset has moved up or down over time. And bear with me if you already know this, I'm going to give you something really interesting at the end of this video, and it's called the Bitcoin Volatility Index. We're going to take a look at it together. It's really fascinating. But generally, the more volatile an asset is, the riskier it's considered to be as an investment. When we look at a stock, much less riskier than crypto, at least generally speaking. There are such things as penny stocks, which can become extremely volatile as well. However, if something is more volatile, the more potential it has to offer higher returns, as we see a lot in the DeFi space and the community coin space here in crypto. But it can also go the other way as well. As we've all seen, we've had high losses over short periods of time compared to, comparatively to less volatile assets in a short period of time. But that's the game we play. Just know that you're not going to win every trade. It is an extremely volatile market. You're going to lose. You're not going to win all the time. But if you can win, let's just say 60% of the time, you're going to win over the long haul, right? Now, let's keep going here, because when people talk about measuring volatility, they're usually referring to historical volatility, a number derived from a study of prices over a specific time period. Usually when we're talking about stocks or crypto, it's often like a month period, 30 days, or a year period if you zoom out, okay? Now, why is volatility important to understand? Well, higher trading volumes on Bitcoin, by far the biggest crypto by market cap, and increased institutional participation seem to be reducing its volatility over time. Now, this asset class in particular is only a little more than a decade old, and crypto has seen a series of steep rises, especially early on. We're going to get into that here in just a minute. But DeFi tokens tend to have way more volatility. When experimenting with these assets as a beginner, please be careful, because there is a lot of risk associated with investing in these types of assets. So as I always say, only invest what you are willing to lose. Now, are there ways that you can actually reduce volatility? If you're new to the space, you're coming into crypto, you want to do it, but you just want to kind of dip your toes in. You don't want to go all the way in, or maybe you've got wrecked too many times and you want to dial it back and you want to reduce volatility, reduce your risk a little bit. Well, sure. The number one way to do so, dollar cost average. So for less risk tolerant investors, this is the number one strategy that can be used to limit the downside impact of volatility. So some people elect to do this every single day, maybe every single week they invest into Bitcoin and Ethereum, for example, or every single month they invest, say the 15th of every month. This is something that Coinbase does. That's actually where we're at right now on this site. So this is something that's totally up to you. But if you do this, you don't have to be as much of an active investor and watch the market all the time and try to time it up. Because when you try to time the market time and time again, you'll get wrecked. Okay? For sure. Of course, you can time it and be right sometimes, and it feels really good. But if you just want to be a passive investor and you know Bitcoin and Ethereum are here to stay, at least that's my opinion, and you just want to slowly put money into it, dollar cost averaging is the way to go. And then, of course, there are other opportunities out there like staking and investing into stable coins. So these cryptocurrencies are specifically designed to have low volatility, called stable coins, including USDC, the DAI coin, of course, Tether, right? These have their price pegged to a reserve asset like the US dollar. Now, when we talk about crypto and stocks, crypto comparatively to stocks, we're talking about extremely volatile to highly volatile with stocks. Cryptocurrency is new and uncertain wealth building, which also makes it really enticing for new people to come into the space, where stocks are tried and true wealth building over time, right? You're looking for those 7, 8, 9, 10% gains year over year. where you could see that in 5 minutes in crypto, right? A minute. Where crypto lacks complete regulatory framework, at least right now, stocks are regulated primarily by the SEC. However, we are in the midst of a regulatory framework being built right now in the United States for crypto, which, of course, I covered in my last video, is actually a good thing. Now, I want to take you over to the Bitcoin volatility time series charts, and this is really fascinating. So, the Bitcoin volatility index measures how much the price of Bitcoin fluctuates on a specific day relative to its price. So you can see we're going to take a look at some historical and average volatility of Bitcoin below. Now, we've got a 4.43%, volatility index percentage score here for the 30 days, and we've got about a 4% on the latest 60-day estimate. Now, if we look at it from a historical perspective, and I want to zoom all the way out to August 16th, 2010, when Bitcoin was created. Look how volatile this was. I mean, just absolutely insane. So these percentages were hitting 16%, 14% swings, 13% swings. Look at this. All the way from 2010 till about 2016, it was really volatile. Something happened, though, right in here. Look at 2016 and beyond. We've gotten a lot less volatile. Of course, we got really volatile here in 2020 due to an influx of retail money coming into crypto when COVID hit, right? That is exactly what happened. It lines up directly. March 30th, 2020, everybody was reserving the money they had, and they wanted to get it into crypto as a hedge against inflation. So outside of that big spike there you see on the March 30th, 2020, we have slowly reduced our volatility over time, and this will continue to be the case as more institutional money and retail money comes in and piles into crypto. Right now, we're at 4% globally in terms of people who are invested in cryptocurrencies. When that number reaches 10%, volatility will decrease. And it's going to be a lot easier for investors to stomach investing in Bitcoin and Ethereum. So that's why I say when you're investing in it today, we are all super early. And again, remember, if you don't want to have the churning of the stomach all the time and the constantly looking at the phone, dollar cost average is your best option. And hopefully you got some interesting insight out of this video on crypto volatility. Let me know your thoughts about all of this down below in the comments section. As always, thank you so much for stopping by. Smash the like button, subscribe if you got some value, and I will see you all in the next video. Take care.